I am Mark Roach, and this is FutureWise Energy, an innovative voice in independent upstream energy. Now, everyone's talking about oil tankers' use of force and underlying motives. On December 10th, yesterday, the United States Coast Guard seized a very large crude carrier called the Skipper off the coast of Venezuela, carrying about 1.8 million barrels of heavy crude bound for Cuba and ultimately China, they say. That was not a headline. I mean, that was a marker, structure, signal, or maybe both. After spending several years working in Caracas and leaving when Chavez was let out of prison, this is an interesting saga to watch nearly 30 years later. So this vessel is part of what the industry calls the shadow fleet. Over 30 sanctioned tankers currently operating in Venezuelan waters now face the same risk, and shipping sources there's many vessel operators that are reconsidering departing and changing their plans. That matters because Venezuela exports roughly 900,000 barrels of oil, crude, per day, and about 67% of that output is heavy crude, the kind that runs in cokers and hydrocrackers on the U.S. Gulf Coast. Here is what most people are missing, or may just not be tuned into. This is not about Venezuela necessarily. This is about diesel margins, refinery configurations, and which producers hold the cards when heavy crude gets scarce. The U.S. Gulf Coast refineries were designed decades ago to process heavy sour crude from Venezuela, Mexico, and Canada. Over the last 5 years, Venezuelan imports to the U.S. dropped from 500,000 barrels per day to near zero under heavy sanctions. Mexican heavy crude exports fell from 745,000 barrels per day in 2023 to 400,000 barrels a day in 2025 this year, as Mexico built the Dos Balcos refinery to keep more barrels domestic. Now, that created a structural gap of 200,000 to 500,000 barrels per day that someone had to fill. Well, Canada stepped in Western Canada Select crude oil. It now provides about 3.9 million barrels per day to the U.S. refiners, which is the largest country-to-country crude flow on the planet. But Canadian Heavy has pipeline constraints, and the Trans Mountain expansion only adds incremental capacity, mostly aimed at Asia, not the Gulf Coast. So what happens when Venezuelan barrels that were going to China through shadow tankers suddenly face interdiction risk? Chinese refineries need that heavy crude for their secondary conversion units. If those barrels do not arrive, they compete for the same Canadian and Middle Eastern heavy grades that U.S. refiners depend on. That tightens the global heavy crude market and pushes up the price of Western Canadian Select. For U.S. upstream producers, this creates two dynamics worth watching. First, the heavy crude differential narrows. Domestic sour grades like Mars and West Texas Sour already trade at premiums when Venezuelan supply gets disrupted. If interdiction becomes a pattern, not a one-off event, then those differentials widen further, and U.S. producers with sour production in the Permian or the Gulf of Mexico or America see better realizations. Second, Canadian producers gain leverage. They can redirect barrels to Asia via Trans Mountain if U.S. Gulf refiners do not pay competitive prices. That optionality did not exist 3 years ago, and now it does. The U.S. is no longer the only buyer, and that changes the negotiation. But there is a risk if this escalates into broader conflict, or if Trump moves toward regime change in Venezuela. The transition period could be brutal. Venezuelan production would drop, not rise in the short term. Infrastructure is decayed. The workforce is depleted. Even under an optimistic scenario where sanctions lift and foreign investment floods in, well, it would take 3 to 5 years to add meaningful production. The Atlantic Council estimates that you might see 200,000 to 300,000 barrels per day come back initially, but nothing close to the 3 million barrels per day that Venezuela was producing in the 90s when I was working down there. In the meantime, diesel prices move. Diesel is the margin product for heavy crude refineries, and the International Energy Agency already warned that middle distillate markets are tight. A sustained loss of Venezuelan heavy crude would hit the diesel hardest, not gasoline. And that flows through to trucking cost, shipping cost, food prices. So for upstream U.S. producers, the calculus is this. If Venezuelan interdiction becomes systematic and Chinese buyers scramble for alternative heavy crude, your Canadian competitors get pricing power and your domestic sour barrels get a lift. If this turns into prolonged conflict and Venezuelan production collapses entirely, you get a short-term price spike followed by years of elevated heavy crude prices until new supply comes online, possibly from Guyana, possibly from deepwater Gulf of Mexico or Gulf of America, possibly from nowhere. The interdiction of the skipper is not just about 1.8 million barrels, it's about whether the U.S. is willing to enforce a physical blockade on Venezuelan oil, and if so, who fills the gap and at what price? The market will tell you the answer before any government does. Watch the Mars sour differential. Watch the Canadian heavy flows into Asia. Watch Chinese teapot refinery run rates. If those three data points start moving in the same direction, you'll know the blockade is real and the scramble for heavy oil has started. I'm Mark Roach. This is FutureWise Energy. Consider that the most expensive barrel is the one you did not plan for. And who can really plan when the powers that be are calling the shots? The future of the world dominance, well, it certainly appears to be in play right now, right before our eyes.